Most people still believe silver costs around $70 an ounce because that's what a screen tells them. But screens don't matter when a market breaks. Reality does. And right now, reality is charging a very different price than what you're being shown. At this exact moment, if you try to buy physical silver, hold it in your hand and take delivery, you are not paying $70. You're paying closer to $120. Not tomorrow, not hypothetically, right now. When a market shows two prices at the same time, one of them is lying. And it's never the one people are actually paying. That kind of split only happens when supply has already snapped, but the official market hasn't admitted it yet. 2 weeks ago, physical silver dealers across the United States were charging around $120 for a 1-ounce coin. At the exact same time, every financial app on your phone was still showing silver trading near 77. That gap wasn't a rounding error, and it wasn't a temporary premium. It was a 56% disconnect between paper price and physical reality. When a market does that, it's either broken, or it's in the middle of a wealth transfer most people won't notice until it's already over. And this one didn't start in the US, and it didn't start on Wall Street. It started quietly, at midnight, on January 1st, while most of the Western world was distracted by the new year. That's when China flipped a regulatory switch that instantly removed nearly half of the world's tradable silver supply from global markets. There was no press conference, no warning, just a rule change, and consequences that are already rippling through the global economy. On January 1st, China implemented new export licensing requirements for silver refiners. On paper, they looked reasonable. Refiners now need to produce at least 80 tons annually and maintain $30 million in credit lines to qualify for export licenses. The problem is that most refiners in the world don't operate anywhere near that scale. They're smaller, specialized operations, family-run businesses and regional facilities that have refined silver for decades, but not at industrial megascale. Overnight, 93% of global silver refiners became ineligible to export. That number alone should stop you cold. Think about what that actually means. Imagine waking up tomorrow and discovering that 93% of gas stations in your country are no longer allowed to sell fuel. The fuel still exists, but it can't legally reach you. That's exactly what just happened to silver, and it gets worse. China already controls approval authority over roughly 60-70% of global silver refining capacity. Now, only a small fraction of those refiners can legally export, and even they face approval timelines of 4 to 6 weeks per shipment, with reported success rates below 20%. For industrial buyers, that's a death sentence. Between December 27th and January 1st, something extraordinary happened, but it was buried in holiday noise. Electronics manufacturers, solar companies, and EV suppliers, industries that rely on silver to function, started receiving identical emails from their Chinese suppliers. Contracts were canceled. Shipments were terminated. No exceptions were made. The reason cited every time was failure to meet the new export licensing requirements. Roughly 400 million ounces of annual silver supply vanished from global markets in a matter of days. To put that in perspective, total global silver mine production is about 800 to 900 million ounces per year. Nearly half of all tradable supply just disappeared, and it happened while Western markets were closed. Now here's where this starts affecting real life. Silver isn't a speculative metal. It's a critical industrial input that modern technology cannot function without. If you're planning to install solar panels, silver is the primary conductor in photovoltaic cells, and there is no scalable substitute. If you care about electric vehicles, silver is essential for charging infrastructure and battery management systems. Every smartphone, laptop, data center, and telecom network depends on silver for high-efficiency electrical conductivity. And the industrial buyers who lost those contracts are now scrambling to replace hundreds of millions of ounces of supply. But there's a problem. There is no buffer. According to official commodities exchange data, registered silver inventories available for delivery have collapsed by about 70% since 2020. We have gone from roughly 140 million ounces in approved warehouses to around 42 million ounces today. That might sound like a lot until you realize global industrial consumption runs at 500 to 600 million ounces per year. What's sitting in exchange vaults represents about 1 month of global demand, assuming every ounce is actually available, which industry insiders say is generous. London vaults tell the same story, with holdings down roughly 40% over the past 3 years. Shanghai inventories are even worse, hitting decade lows at the same time China is restricting exports. China is drawing down its own silver reserves while locking the rest of the world out. That combination is never accidental. Now watch what happened just before the restrictions went live. In October, China exported a record amount of refined silver, the highest monthly total in years. At the time, analysts called it bullish. What they missed was the timing. Those exports happened just weeks before the January restrictions took effect. Silver left the country while it still could. That's not coincidence. That's positioning. And while most people were distracted, someone else was paying attention. Search data shows interest in buying silver hit all-time highs in late December, higher than during the 2011 silver spike. Private vaults in the US and London reported massive physical withdrawals during the holiday week. These weren't retail buyers picking up a few coins. These were 9-figure orders. This is the difference between the paper market and the physical market. Paper silver, futures, ETFs, and contracts exists on the assumption that physical metal will always be available when delivery is requested. Physical silver exists in the real world, where manufacturers need actual metal to keep factories running. When those two prices diverge, the physical market is telling you the truth first. Right now, the paper market is still pretending everything is normal. The physical market has already repriced reality. Try calling a major bullion dealer and asking for immediate delivery of 1,000 ounces. If they even agree to deliver, you'll be quoted 30-50% above spot. That gap hasn't been this wide in 45 years. And now comes the math most people don't want to look at. China removed about 400 million ounces of refined silver supply. The question is where replacement supply comes from. At best, you're looking at roughly 150 million ounces of uncontracted mine production, 42 million ounces in registered exchange inventory, perhaps 100 million ounces in London vaults not already committed, and maybe 25 million ounces scattered across dealer inventories. Add it all up and you get 280 to 330 million ounces in a best-case scenario. That still leaves a structural deficit of 70 to 120 million ounces per year, and that deficit is not temporary. Most silver is produced as a byproduct of copper, lead, and zinc mining. Only about 30% comes from primary silver mines. You can't just mine more silver on demand. Even if prices triple tomorrow, new production takes years to come online. One major mining executive recently admitted that even at extremely high prices, meaningful production increases would take at least 3 years due to permitting, equipment, and labor constraints. So when supply can't rise and demand keeps growing, price becomes the rationing mechanism. Industrial buyers don't have the option to wait. They either pay the price or shut down production. That's where the price projections come from. Not hype, not charts, math. The gold to silver ratio has already started moving. Historically, it averages around 80, but based on relative abundance and industrial demand, many analysts argue the natural ratio is closer to 35. Even at conservative assumptions, that math puts silver deep into triple-digit territory, and that's before accounting for inflation-adjusted historical highs. Silver peaked around $50 in 1980 and 2011. Adjusted for monetary expansion, those highs would be several $100s today. Silver is still nowhere near those levels. At the same time, industrial demand is accelerating. Solar installations are growing 15-20% annually. EV production is doubling over the next few years. 5G infrastructure requires far more silver than previous generations. There is no viable substitute. Manufacturers have tried copper, aluminum, and graphene, but nothing matches silver's performance at scale. That makes demand price inelastic. When prices rise, demand doesn't disappear. It gets passed through the system. That's how supply shocks ripple into the real economy. Solar installations get more expensive. Electronics prices rise. Infrastructure projects get delayed. Margins shrink. Layoffs follow. And eventually, consumers feel it. Now look at the timeline. As markets reopen, paper prices will start chasing what the physical market already knows. January brings volatility and repricing. February brings supply chain failures becoming public. By the time headlines catch up, the easy positioning is gone. This isn't about panic. It's about understanding structural changes while most people are still focused on outdated prices. When you see a $120 physical price and a $77 paper price, that's not confusion. That's a warning. The mechanism is already in motion. The inventory is already depleted. The restrictions are already in place. The only unknown is how long it takes the broader market to accept reality. And when it does, the price won't move gradually. It never does. The question isn't whether silver reprices. The evidence says it already has. The question is whether you recognize the signal now, or only after everyone else does. Because 6 months from now, today's prices may look very different in hindsight, and moments like this don't announce themselves twice. If this breakdown helped you understand what's really happening beneath the surface, share this with someone who still believes the spot price tells the whole story. Subscribe if you want more deep dives like this, focused on real supply, real data, and what actually moves markets before the headlines catch up. And let me know what you think. Do you believe this gap closes through higher paper prices, or through physical silver becoming harder to find? Drop your view in the comments.